Listen carefully, because what I am about to reveal could be the difference between catching the opportunity of a decade or watching it slip through your fingers. Right now, as you're watching this video, the largest forced selling event in silver market history is about to unfold. And before you think this is just another clickbait headline, understand this. The information I'm sharing comes directly from JP Morgan analysts, TD Securities strategists, and the very institutions that control billions in commodity markets. They're not hiding this. They're telling us in plain language what's coming. But here's the twist that nobody else is talking about. While the Western financial system prepares to dump billions worth of silver, China just locked the vault. If you want to understand how to position yourself for what's coming next, make sure you hit that subscribe button and turn on notifications right now, because Final Wealth Warning is about to break down the single most important commodity event of 2026. Between January 8th and January 14th, over $5 billion worth of silver will be forcibly liquidated on the COMEX. That's 13% of the total open interest in silver futures being sold in a 5-day window. To put this in perspective, we're talking about 13,000 contracts that must be sold. Not because traders want to sell, not because the fundamentals have changed, but because an algorithm demands it. JP Morgan's analysis is crystal clear. They estimate between $3.8 and $4.7 billion in silver sales during this rebalancing period. TD Securities went even further. Daniel, their senior commodity strategist, stated that this massive selling would result in a dramatic repricing lower. These aren't small players making educated guesses. These are the institutions that move markets, and they're telling you exactly what's about to happen. Now, before you panic and think silver is doomed, let me explain the mechanics behind this, because once you understand how this works, you'll see why this is actually setting up an incredible opportunity. The Bloomberg Commodity Index is one of the most tracked commodity benchmarks globally, with approximately $109 billion in funds using it as their reference point. These aren't active traders making smart decisions based on market conditions. These are passive funds that mechanically buy and sell based on index weightings. Right now, silver represents about 9% of this index. But for 2026, that target has been slashed to just below 4%. That's more than a 50% reduction. The algorithm doesn't care that silver had its best year since 1979. It doesn't care that demand is outstripping supply. It doesn't care that China just implemented the strictest export controls in history. The algorithm only knows one thing: sell until we hit 4%. And that's exactly what it will do. Here's where it gets interesting, and this is where you need to pay close attention, because this is the part that separates those who understand markets from those who just react to headlines. JP Morgan added a critical warning in their December 12th note. They said that given lower liquidity overall, there remains a risk that this outsized silver selling could be more disruptive to prices this time around. Think about the timing. We're coming off the holiday period. Trading desks are understaffed, order books are thinner than normal, and into this low liquidity environment, $5 billion of selling pressure is about to hit. The conditions are perfect for a sharp move lower. The headlines will scream that silver is collapsing. Weak hands will panic, and that's exactly when smart money steps in. But while everyone focuses on this temporary selling pressure, something far more significant is happening on the other side of the world. On January 1st, 2026, China activated the most comprehensive export control regime for silver in modern history. They published a list of exactly 44 companies authorized to export silver. Every other company in China is now prohibited from exporting without going through these approved channels. This isn't a minor policy adjustment. This is a fundamental restructuring of global silver supply. China is one of the world's largest silver producers and refiners. In the first 11 months of 2025 alone, China exported over 4,600 tons of silver. That's approximately 148 million troy ounces flowing into the global market. European solar panel manufacturers, American electronics companies, Japanese battery producers, they've all depended on this Chinese silver to meet their production needs. And as of January 1st, that supply is now under government control. A source quoted by the Securities Times, which is affiliated with China's official People's Daily, stated that the new silver export controls signify its official inclusion in the National Strategic Resource List. They added that silver management is now at the same level as rare earths. Let that sink in for a moment. China has elevated silver to the same strategic importance as rare earth minerals, the materials that go into fighter jets and missile guidance systems. They're weaponizing silver as a tool of geopolitical leverage, and the timing is no accident. This move came right after the United States officially added silver to its critical minerals list in November 2025. Washington recognized that silver is essential for solar cells, batteries, electrical circuits, and antimicrobial medical devices. Beijing responded by tightening their grip on supply. This is resource warfare playing out in real time. Even Elon Musk, the CEO of Tesla and owner of the X platform, publicly criticized China's action. He wrote, and I quote, Silver is needed for many industrial processes. It is not good. When the richest man in the world, someone who runs multiple companies that depend heavily on silver, takes to social media to complain about supply restrictions, you know the situation is serious. Tesla needs silver for every vehicle it produces. SpaceX needs it for electronic systems. Musk understands that these export controls threaten his entire industrial empire, and there's nothing he can do to stop it. Now let's connect these two massive forces, because this is where the picture becomes truly extraordinary. On one side, we have the Bloomberg Commodity Index forcing $5 billion of silver sales over the next 2 weeks, creating massive downward pressure on paper prices. On the other side, we have China locking down physical silver exports, treating it as a strategic national resource, creating massive upward pressure on actual supply. What happens when you smash the paper price while simultaneously restricting physical supply? You get a divorce between paper markets and physical reality. We've seen this playbook before. We saw it in palladium when Russia restricted exports and prices went from $500 to $3,000. We saw it in rare earths when China imposed quotas and prices multiplied tenfold. We saw it in rhodium when supply dried up and prices rocketed from $2,000 to $29,000. The pattern is always the same. First, physical supply gets constrained. Then paper markets try to deny reality. Then reality wins and prices explode higher. Right now, we're in stage 2. The paper market is about to deny reality by smashing prices lower during index rebalancing. But stage 3 is coming, and when it does, reality is going to win. Here's the fundamental backdrop that makes this setup even more compelling. Silver rose approximately 24% in 2025. It outperformed major tech stocks that dominated financial headlines. Gold rose around 27%, also its best performance in decades. Precious metals were the trade of the year. Yet, as we enter 2026, mainstream financial media is focused entirely on the impending crash, the index rebalancing, the short-term selling pressure. They're completely ignoring the structural supply deficit that's getting worse every single month. Global silver production is approximately 820 million ounces per year. Global silver demand has exceeded 1.2 billion ounces annually for several consecutive years. We're running an annual deficit of nearly 400 million ounces. That deficit has been filled by above-ground stockpiles, recycling, and Chinese exports. If China restricts those exports, if they decide their domestic solar industry and electronics manufacturing should have priority access to their own silver production, the deficit explodes. The price must rise to ration remaining supply. There's no other mechanism. There's no magic solution that creates more silver out of thin air. The math is the math, and the math says higher prices are inevitable. The index rebalancing is going to create a gift for those who understand what's happening. It's going to artificially suppress prices for a brief window while the physical market gets even tighter. The algorithms don't care about China. They don't care about supply deficits. They don't care about the strategic importance of silver for the energy transition. They only care about matching index weightings, so they'll sell relentlessly for 5 trading days. And when they're done, the market will look around and realize the fundamental picture hasn't changed. It's gotten worse. China locked the vault, the supply deficit continues, and the price will snap back higher like a rubber band stretched too far. Let me walk you through the key levels to watch because the charts are telling us exactly where to look for support and where to expect the bounce. Silver is currently trading in the mid-20s range after hitting highs above $30 earlier this year. The first major support zone is around $28. This is a psychological level that has attracted buyers on previous pullbacks. If index rebalancing drives prices toward $28, expect aggressive buying to emerge. The second support level is around $26, which corresponds with moving averages and retracement levels from the recent rally. A drop to 26 would represent a correction from recent highs, painful for recent buyers, but completely normal in a secular bull market. The third support level is $24. This is the line in the sand. If silver breaks below 24 on a sustained basis, the bullish case comes into question. But I don't expect that to happen. The fundamental supply picture is too tight. Chinese export controls are too significant. Demand from solar and electric vehicles is too strong. On the upside, immediate resistance sits around $30, where we've seen consolidation. A break above 30 with conviction signals, the selling pressure has been absorbed. The next major resistance is the recent high around $32. A break above that puts silver in price discovery mode, where there's no historical resistance to slow the advance. Beyond that, triple-digit silver becomes very much on the table if supply constraints intensify and industrial demand continues growing. Now, let me address strategy, because understanding the situation means nothing if you don't know how to act. If you're a physical silver holder, the strategy is straightforward. Do nothing. Hold your position. Don't panic when headlines scream about index rebalancing. Don't sell into weakness. The paper price manipulation is temporary. Physical supply constraints are permanent. Your silver will be worth more in 6 months regardless of what happens in the next 2 weeks. The fundamentals guarantee it. If you're looking to add to your position, the rebalancing period creates the opportunity you've been waiting for. The algorithms are going to suppress prices for you, creating an artificial discount, handing you silver at below market prices. Take advantage of their mechanical approach. Use their selling pressure to accumulate at lower levels. Smart money will be buying while index funds are selling. Position yourself with smart money, not with algorithms. Make sure you're hitting that like button right now and sharing this video with anyone who needs to understand what is coming in the silver market. Drop a comment below telling me if you're buying this dip or waiting on the sidelines, because I want to know where Final Wealth Warning viewers stand on this historic opportunity. Let me give you the exact timeline so you know what to expect. The rebalancing period begins January 8th. Selling will be concentrated over 5 trading days ending January 14th. Each day, index funds will sell approximately 2,600 contracts of silver, roughly 13 million ounces daily. Selling will be most intense in the first 2 days as funds rush to meet targets. By period end, approximately 65 million ounces of paper silver will have been dumped onto the market. Watch price action carefully during this window. If silver holds above $28 despite the selling, it signals extraordinary underlying strength. If silver drops to 26 but bounces quickly, it signals healthy absorption. If silver crashes through 24 and can't recover, it signals something more concerning. But I don't expect that scenario. The buyers are waiting. Physical demand is too strong. Chinese restrictions are too tight. The bottom will be bought. After January 14th, selling pressure evaporates. Index funds will have completed rebalancing. Artificial suppression ends and markets return to trading on fundamentals. That's when reality of the supply situation reasserts itself. That's when prices begin the next leg higher. That's when those who bought the dip get rewarded for their patience and understanding of market structure. Let me address what some of you are thinking. Is this rebalancing really just coincidence? The index decides to cut silver weighting in half right after silver's best year in nearly 5 decades. Rebalancing happens right as China implements export controls. Selling pressure hits when liquidity is lowest following holidays. Is this mechanical index maintenance or something more coordinated? I'm not telling you there's a secret conspiracy. I don't have proof of coordination between index providers and bullion banks, but I'll tell you what I observe. Every time silver threatens to break out, some mechanical force appears to suppress prices. Rules seem to change whenever retail investors start winning. Institutions always seem positioned on the right side of these events. Maybe it's coincidence. Maybe it's just how markets work. Or maybe the game is structured in ways not immediately visible. Regardless of cause, the effect is the same. Prices will be suppressed short term, creating opportunity for those who understand. Here's the bigger picture, because this rebalancing event, as dramatic as it is just a blip in the secular bull market for silver. We're in early stages of a generational repricing of precious metals. The old monetary system built on unlimited currency creation is breaking down. The new system will require hard assets as foundation. Silver and gold will play central roles in that new system. The Chinese understand this. That's why they're stockpiling. That's why they're restricting exports. That's why they're treating silver as strategic national resource. Americans are starting to understand too. That's why they added silver to the critical minerals list. That's why they're scrambling to secure domestic supply chains. That's why the Department of Defense is suddenly interested in precious metals availability. The transition is underway. The old system is dying. The new system is being born. And silver sits at the center because it bridges the gap between monetary metal and industrial metal. It's the one asset benefiting from both safe haven demand and technological demand. The index rebalancing is the last gasp of the old system trying to suppress what can't be suppressed. Algorithms don't understand China. They don't understand supply deficits. They don't understand the energy transition. They only understand mechanical rules. Those rules are about to create a buying opportunity of a lifetime. Don't let them shake you out. Don't let red candles scare you. Don't let headlines convince you silver is crashing. The paper price is being manipulated by a mechanical process having nothing to do with fundamentals. Physical reality is that silver is scarcer than ever. Industrial demand is stronger than ever. Monetary demand is growing as faith in traditional currencies erodes. Every fundamental factor points higher. The rebalancing is temporary. The bull market is permanent. This is the perfect storm. The paper market is about to dump $5 billion of silver, while the physical market is locked in Beijing vaults. The collision of these forces will create volatility unlike anything we've seen. But volatility is opportunity for those prepared. And now you're prepared. You know what's coming. You know why it's happening. You know how to position yourself. The only thing left is execution. The next 2 weeks will test your conviction. The next 2 weeks will test your understanding. The next 2 weeks will separate weak hands from strong hands. Be a strong hand. Be the buyer when everyone else is selling. Be calm in the center of the storm. Prices may drop, headlines may scream, algorithms may dump, but fundamentals don't lie. And fundamentals say silver is going much higher. If you found value in this analysis, make sure you're subscribed to Final Wealth Warning. Hit that notification bell and share this with anyone who needs to understand what's really happening in the silver market. Comment below with your thoughts, and let's build a community of informed investors who see through the noise. The opportunity of a lifetime is about to present itself. Don't miss it. I'll see you in the next video where we'll track exactly how this plays out.